Hello everyone, welcome back to our channel. This is Vaibhav Bansal. Today we are going to start with the another part of the non-resident chapter. Today we are going to complete the non-resident chapter, the remaining portion that we have left. So starting with the residential status of a company. What is the residential status of a company? Okay, for the residential status of the company, first you need to check whether it is an Indian company. If it is an Indian company, that it always be a resident. Okay, but for another company which is not an Indian company, it will always be dependent on the poem, the place of effective management. By the poem itself, we will determine whether the residential status of the company is in India or outside India. So it will depend on the place of effective management. Is this clear? How we will determine the place of effective management is in India or outside India? For that, we have to check the active business outside India test. We have to check what in our active business outside India test, the ABOI test. Okay, so what is the ABOI test? For the ABOI test, you have to check the four conditions. All these four conditions must be satisfied in order to check whether the active business outside India or not. All these four conditions should be cumulatively followed. Okay, what is the first condition? If passive income is not more than 50% of its total income, the passive income is not more than 50%, less than 50% of its total assets are situated in India, less than 50% of its total assets are situated in India and or are resident in India, the payroll expenses on such employees are less than 50% of its total payroll expenses. These are the four conditions. First condition says if the passive income is not more than 50% of its total income. Is this clear? Is not more than 50%. So what is the passive income? We will determine what is the passive income in this case. So see, passive income includes royalty, dividend, capital gains, rental income, interest. But interest shall not include for the banking company or the PFI companies. Okay, interest is not included for the banking companies and the PFI companies. Otherwise, all the royalty income, dividend income, capital gain income, rental income, interest income, all will be covered here in the passive income. Okay. Second point, the purchases and sales both are from the associated enterprises. So what is associated enterprises? That we will cover under the transfer pricing chapter. The next chapter will be our transfer pricing chapter only. Okay, so what is the associated enterprises? It is like a related party. Okay, you can understand as for this chapter, it is like a related party. But what is the associated enterprises? We will cover everything in detail in the transfer pricing chapter. Is this clear? But what includes passive income is purchases and sales. We are purchasing and we are selling to our associated enterprises only. Then both the transaction purchase and sale is done with the associated enterprises, then it will cover under the passive income. Is this point clear? Now, what is the value of assets? Here it comes that the less than 50% of its total asset are situated in India. Less than 50% are situated in India. So we have to calculate what is the value of asset. So for depreciable asset, WDV as per the income tax law of that country will be the value of that asset. But for any other asset which is not depreciable asset like land is not a depreciable asset. So for land, value as per the books of accounts to be treated. Is this clear? Other asset value as per the books of accounts shall be treated. Now, we have covered in the third point, less than 50% of its total employees are situated in India or are resident in India. Less than 50% of its total employees are situated in India. So what does total employees comprises of? So see, number of employees, how we calculate number of employees? Average of employees at the beginning and at the end of the year shall include contractual employees as well. What it says, like for at the beginning of the year and at the end of the year, take the number of employees. Do the average of those number of employees. You will get a number which will be treated as the number of employees. You have to see that whether these employees is less than 50%, is less than 50%. If it is less than 50%, then the condition will be satisfied. Is this clear? This point is clear. Now, what are the payroll expenses? Okay. Now for payroll expenses includes the salary, bonus, wages, and all other employee compensation. Every other employee compensation will be covered under the payroll expenses. So salary, bonus, wages, and all other employee compensation expenditures will be covered as a payroll expenses. Is this clear? Now, what are the incomes? If the country has a tax law, so the income as per the income tax law of that particular company shall be treated as income. Okay, but if the company is not having any if the company is not having any income tax law, then the income as per the books of account shall be treated as income. Is this point clear? Now we have to check whether this test is passed, whether all the four conditions are satisfied cumulatively. If all the conditions are satisfied cumulatively, then we have to check whether the majority board meetings held outside India. If the majority of the board meetings are held outside India, then the poem is outside India. Okay, but suppose the majority of the board meetings are outside India, are held outside India, but the power of the holding company, the power is exercised by any holding company or any person which is a resident in India, which is a resident of India. Like there is a company whose majority of board meetings are held outside India, but there is a holding company of that company which resides in India, which is a resident of India, or suppose there is a key person who take the majority of that decisions of that company who is a resident in India. So if there is any person who exercise any power, or is there any company who exercise any power to another company whose majority of the board meetings are held outside India, then as well though that company, the outside company, will be treated as a resident in India, and we will treat that poem, place of effective management of that company, is in India. So what it says, majority board meetings held outside India, poem outside India, it will be treated as poem is outside India. But if power is being exercised by the holding company or another person resident in India, then poem shall be in India. If any of the power is exercised by any person which is a resident in India or any company which is a resident in India, then the poem shall be in India of that particular outside company. Okay, now, but suppose this test is not passed, these condition, the all four conditions are not satisfied, or any of the condition is not satisfied, so the ABOI test is not satisfied. If this condition becomes so, we have to check, identify the person making company's key management and commercial decisions. Who is the person who is making the company's key management decisions, and where that place such decisions are being made, and what is the place from where that particular person uh, are taken the decisions of the company. Okay, for that the CBDT have given some particular guiding principles that you have to check. What are those particular guiding principles? Let me let you know. These are just just a read and let go of the of kind of things. Okay, first is location of substantial board meetings or executive committee or head office. What is the location of the substantial board meetings, where those substantial board meetings are held? What is the location of the executive committee and what is the location of the head office? This will play a crucial role in determining whether the poem is in India or not, in the case where the ABOI test is not passed. Is this point clear? But if there is a system, like there is a there is a head office and there are branch offices of that head office, and suppose the that head office has done so much of decentralization in their offices that every particular office has their own decisions. Every particular office can take their own decisions, whether they can for every particular thing they can take their own decisions. So there is a decentralized form of thing. So it is not possible for to determine from where the exact positions of the decisions are taken from the head office or not. So for that kind of particular offices, it is not reasonable. It is not of much relevance where the decisions are taken or where is the location of the head office is taken place. Okay. So, but if there is a senior management is so decentralized that it is not possible to determine the company's head office with a reasonable degree of certainty, the location of head office will not be of much relevance for determining POEM. Second is use of modern technology from where the online meetings are being held, decision via circular resolution and round robin votings. And the most important thing which you need to understand that decisions by shareholder or day-to-day decisions are not relevant factors for determining the place of determining the place where such decisions are being taken care of. Is this clear? The decisions by shareholder or day-to-day decisions are not of any relevance. Is this point clear? Now, coming to the next point. These provision of POEM will be applicable only if the company's turnover exceed 50 crore. What it says? Exceed 50 crore, not equal to 50 crore. It is exceeding. It should be exceeding 50 crores. So the provisions of POEM is applicable only if the turnover exceeds 50 crores. Below the 50 crore, the turnover is, if the turnover is below 50 crores, then the provision which we have studied till now, the residential status of the company, the provision of POEM will not be applicable in all. Is this point clear? Now coming on to the point. Like we have said, we have to check the passive income, we have to check the total assets, we have to check the total employees, we have to check the payroll expenses, we have to check everything. So for how many number of years we have to check this? So we have to check as per the data. If the data is available for the current year and the last two previous years, then we have to take all those 3 years, the current year and the last two previous year. But suppose the data is not given for the last two previous years, the data is given only for the current year. So we have to take that year only and take that average of those data. Is this clear? The law says we have to take the average of the data of the previous year and the last two previous year. We have to take total of 3 years, but suppose the data is only available for the 2 years, so we will take the average of the 2 years only. Take the available data. Is this clear? This is the whole provision of the POEM that we have completed in just 10 to 12 minutes. Is this point clear? This is the shortest this is the shortest provision of the residential status of the company which you have ever studied, and it covers everything which the residential status of the company. If you see from the ICA study material, it is running in number of pages. It is running in 3 to 4 pages, but we have summarized everything in this half page only, and this is just the definition part only. Is this point clear? Now coming on to the next portion. What is the scope of total income? We have just above determined who is a resident, who is a non-resident. We who is a resident and ordinary resident, and who is not who is resident and not ordinary resident. But why we have determined this? We have determined this because when we have determined who is a ROR, who is RNOR, and who is NR, on that basis only we are going to tax the income. On that basis only we are going to tax the income. Okay, so see, when there is an income in Indian income, what is the Indian income? Whether income is received in India or deemed to received in India, or income accrued in India or accrue or arise or deemed to accrue or arise in India, there is any provision which is first is whether the income is received or deemed to received in India, it is an Indian income. Secondly, income accruing or arising or deemed to accrue or arise in India, this is also a Indian income. In both the cases, see, ROR is going to taxable at the global income. The global income of the ROR is going to be taxable. Okay, so the ROR is going to taxable at every point of time. Okay, but there are certain conditions for the RNOR and NR. But if there is a Indian income, if it is a Indian income, then there is no exception for RNOR and NR as well. Both the in taxable. For RNOR also Indian income are taxables, and for the NR also Indian income are taxable. But the difference comes in the foreign income. Now, understand it very carefully. What is the foreign income? If there is a business or profession which is controlled or set up in India, income which is earning in foreign. I am earning income in foreign, but the income is controlled from a business or profession which is controlled or set up in India. Then it is a foreign income, which is taxable to ROR, which is also taxable to RNOR because it is set up in India. It is taxable to ROR and RNOR, but not taxable to non-resident. Any foreign income will not be taxable to any non-resident. Okay, so no foreign income will be taxable to non-resident. ROR will be taxed at the global income. Now left with the RNOR. RNOR will be taxed for the income from business or profession controlled or set up in India, but not for the any other income which is from the foreign income. If the foreign income is earning apart from the income from business or profession controlled or set up from India, for the others we'll going to not tax for the RNOR. Is this point clear? This is the scope of total income, section number 5. Now coming, see what it says income received in India. What it says income received in India. So income should be received the first time earned in India. It is not to be repatriated to India. Like income earned in UK and you have transferred that income earned in your Indian account. It is not Indian income. Indian income received in India means the income which you have earned should directly be credited to your bank account, should directly be credited to your Indian bank account. Is this point clear? You should not repatriate that you have earned in UK bank account and you have now repatriated to India. It is not Indian income. It will not be deemed to be received in India, or it will not be treated as received in India. It will be a repatriation of income which will be not covered here. So what income received means is here is first time earned and received in India. What is the first time earned and received in India? You can say it's a first hand salary. Okay, the first time earned and received in India should be treated as income received in India. Now we have to check what is income deemed to receive in India. So for that income deemed to receive in India, we have to check the section number 7. Is this point clear? Now coming to the section number 7, what it says, it just a read and go through it. Just this is a section, is just read and skip type of section this is. Okay, contribution in excess of 12% of salary to recognized provident fund or interest credited in excess of 9.5% per annum will be income received or deemed to be received in India. What it says, if you are a employer and you are contributing to the recognized provident fund of an employee, okay, the contribution up to 12% of the salary is allowed. You if you are contributing 12% of the salary, it is allowed. But if you are contributing apart from 12%, say you if you are contributing 15%, you are contributing what, 15%, which is excess in excess of 12%. What is excess? 3%. This 3% will be deemed to be received in India. Is this point clear? Now the interest should be credited at the rate of 9.5%, but if there is an interest rate of 12%, so the excess of 2.5% will be treated as income received in or deemed to be received in India. Is this point clear? This is the point. Now if you are employee or you are employee, you know that there is the deduction of 80 ccd that the employer and employee have to contribute to the notified pension scheme of the government, the NPS scheme of the government. Is this point clear? What it says, if you are a non-government employer, the non-government employer, then the 10% of the salary needs to be contributed to the NPS. And if you are a government employee, then the government employer will contribute 14% of your salary to the NPS. So anything in excess of this, anything in excess of this, like 12%, 10%, the 12%, or maybe the 16%, the excess will be treated as deemed to received in India. Is this point clear? Now coming on to the last. Amount transferred from unrecognized, what it says, unrecognized provident fund to the recognized provident fund, being the employer's contribution and interest thereon, will be treated as income received or deemed to be received in India. Like if you are transferring your unrecognized provident fund, which is said as URPF, in short, which is said as URPF to RPF. If you are converting your URPF to RPF, then the conversion, whatever is the employer contribution and interest thereon will be calculated, will be deemed to be your and deemed to be income received in India, and it will be taxable to all, whether NR, whether ROR, or whether RNOR. It will be taxable to all. Okay, now coming on to the section number 5. Section number 9.1, sorry. Section number 9.1. This is the chart which we are going to study. We are going in every detail. So first is any business in connection in India. So for what is business connection in India? Let us first understand. What is business connection in India? So see, business connection is anything where any business or profession is carried out on abroad by a non-resident. Is this point clear? And in connection with such business or profession, a certain activity is carried out in India. You are carried on business or profession outside India, but in relation to that business, you are doing any sort of activities in India in relation to that business which is outside India. That it comprises the business connection in India. What it says, it is a business connection. What is a business connection? Where any business or profession is carried on abroad by a non-resident and in connection with such business. In such business, what is which is carried on outside India, and which is carried on abroad. With, in such connection, such business or profession, a certain activity is carried out in India. For that business, a certain level of activities are conducted in India, are carried out in India, then that particular activities will be treated as the business connection in India. Okay, and if there is a business connection in India, then we will tax you. Is this point clear? Now, what is business connection? Actually, what include business connection and what exclude business connection need to be taken care of. So first, the definition of business connection comprises includes and excludes. What it includes? So first, starting with the inclusion part. Explanation 2 to section 911. What is explanation 2? It is saying that any business activity carried through a person who acting on behalf of the non-resident. So any person who is acting on behalf of the non-resident, like any agent. We are covering here the agent. What type of agent? It must be the dependent agent. Just a second. It must be a dependent agent. ठीक है? Not independent agent. Independent agent is not covered here in this provision. The dependent agent is only covered here. So see here what it says. Here the agent must be the dependent agent. If the agent is working in the independent capacity, then no business connection. There is a no business connection in this case. Okay. So for constituting the business connection, the agent must be the dependent agent. Is this point clear? Now coming on to the point. It habitually concludes contract or habitually plays the principal role leading to conclusion of contracts by the non-resident. This rule is applicable if the contract is in the name of the non-resident or for the transfer of the ownership of the property owned by that non-resident or that non-resident has the right to use or for the provision of services by that non-resident. Simply what it says. If that particular agent is acting on behalf of the non-resident, but what is it is acting for? It is habitually contracting. It is habitually concluding the contract or habitually plays a principal role in conclusion of the contract. Like on behalf of the non-resident, he is concluding the contracts. Okay, or habitually play a principal role in conclusion of the contract. But this rule is applicable when the contract is in the name of the non if the contract is in the name of the non-resident. It should not be in the name of the agent. That is why it is a dependent agent, not the independent agent. Okay, the contract must be is on the name of the non-resident. The contract for what the contract is taken place, it should be the transfer of ownership of property. Ownership of property of what? The property of a non-resident. or that non-resident has the right to use. If there is a some if there is a right to use of a non-resident and he is going to transfer that right to use to another person, so that right should be of the non-resident. Okay, the agent should not be involved here. Their agent must be a deal maker. Like it is making the non-resident come here, it is also making the other person come here, and they are just taking place, they are just talking to the contract, and habitually the agent plays the role to conclude the contract. Okay, he is the one only which are helping in concluding the contract. Okay, or if there is any for provision of services, if there is a contract for any provision of services, then that provision of services should be by the non-resident, should be given by the non-resident. That services should be given by the non-resident, not by the agent. Is this point clear? So everything must be of the non-resident, the agent must be a deal maker. Is this point clear? Now coming on to the point B. The agent habitually maintains in India a stock of goods or merchandise from which he regularly delivers goods and merchandise on behalf of the non-resident. Suppose, suppose Amazon, suppose Amazon. Amazon says to a person in India or to a company in India that please for me you maintain the stock of Alexa. Alexa is of Amazon. So what it says, Amazon says to a dealer in India that please for me, you maintain the stock of Alexa. I am sending you the Alexa, the bunch of the Alexas from the United States. You just maintain that stock in India. And if there is any order coming from India for the Alexa, you just deliver that. You just deliver that from your store. So what it says, it habitually maintains in India a stock of goods or merchandise from which he regularly delivers good or merchandise on behalf of the non-resident. On behalf of the Amazon, that dealer is delivering the Alexa on order on behalf of the non-resident. Is this point clear? This point is B point is clear. Now coming on to the C point. It habitually secure orders in India mainly or wholly from for the non-resident. He habitually secure order in India mainly or wholly for the non-resident. Why it is mainly and wholly for the non-resident? Because it should be a dependent agent, not should be the independent agent. If it is controlling, it is if it is securing the orders for another non-resident as well, then it will be an independent agent, not a dependent agent. Is this point clear? Or for that non-resident or and other non-resident either controlling, that non-resident is controlling, or that non-resident are controlled by or subject by the common controlling, like that agent is either controlling the non that suppose a non-resident is controlling another non-resident, is controlling just a second, is controlling another non-resident, or that non-resident is controlled by another non-resident, or suppose there is another non-resident who is controlling this and this as well, means it is under the common control. So for that, if it's secure order for another non-resident as well, it will be deemed as business connection. Is this point clear? Now, income should be reasonably attributable to the operations carried out in India. What it says, income must be reasonably attributable to the operations carried out in India. But what is reasonably attributable? So it says such advertisement which targets a person who resides in India or from a person who uses the IP address located in India. Internet protocol address is IP address. So such advertisement which target whom the such advertisement is targeting, the targeting a person who is resident in India or any person who is using the Indian IP address, or Sale of data collected from a person who resides in India, or from a person who uses IP address located in India. Sale of goods or services using the data collected from a person who resides in India, or from a person who uses the internet protocol address located in India. This is what the reasonable attributable means is. Now, business connection excludes. What is exclude? Excluding the D nafra. What it says? D nafra. It must be read as D nafra. It must be read as D nafra. But we should write DED, but we will read as D nafra. Okay, is this point clear? N- Uh, just a second. In the case of a non-resident, following shall be treated not be treated as a business connection in India. What should not be treated what should not be treated as business connection in India? See, business connection should be treated as if the income is reasonably attributable to the operations carried out in India. If the income is reasonably attributable in India, then it is a business connection. But what if the income is not reasonably attributable to India? To the operations in India, then it will be not treated as business connection. It will be excluded from the business connection definition. In the case of a business in respect of which all the operations are not carried out in India, such part of income which cannot be reasonably attributable to the operation in India, is not deemed to accrue or arise in India. Second point, purchase of goods in India for export. If you are purchasing any goods in India because you want to export that good, then it is just the import and export transaction. It will not be treated as a business connection in India. Now, coming on to the next point, like if you see, in the previous year, we have just concluded the G20 in India. So the various news channels from the foreign countries as well came to India and collected the news from India and broadcasted it in their particular country. Is this true? So the persons who is collecting the news in India and collecting the views in India for transmission outside India, for transmission in their particular countries, then we will not treat that as a business connection. We will not treat this as a business connection. Now, shooting of cinematography films in India, like a Hollywood director came to India and shoot a good film about Indians, and they telecast and they picturize that scene in India, and they finally launched the movie in Hollywood. So the shooting of cinematography films in India will not be treated as a business connection in India. Okay, now display of uncut and unassorted diamonds. What it means, like there is a company who is in the mining business. Okay, in mining, the diamonds are collected from the mining itself. So a company which is in the mining business has collected some raw diamonds, which is uncut or unassorted diamonds. It is the raw diamonds. Okay, and they displayed that diamonds. They display that diamonds in the specific special zones that is determined by the central government of India. Okay, if they are displaying that uncut or unassorted diamonds in the specific zones, the special zones that has been notified by the central government by a foreign company which have a mining business, so it will also not be treated as a business connection in India. Is this point clear? Display of uncut or unassorted diamonds in special zones notified by the central government of a foreign company having mining business will not be treated as business connection in India. Is this point clear? We clear. Okay. Coming on to the next one. We are just going to over last here. Till here, we are left with with our chapter. So it's just one or two and a half pages only. Only 2 pages. Now, what is the significant economic presence? See, earlier there was a brick or mortar type of businesses. The businesses which have a structure, like the shops that you are through in India. There are shops, and you just purchase something from the shop. But now our shops are digitalized, like Amazon, like Flipkart. They are paying tax in the residence country, like in the US. Flipkart is of India, sorry, the Walmart, like Walmart, the Alibaba, these are the companies which are of foreign. Okay, they are earning money from India, but they are paying tax in the United States because of the residential status. Is this point clear? So India needs to take some tax from those companies as well. So India made a law. As what is law? The significant economic presence. We will first determine whether your economic presence in India is significant or not. If it is significant, then you have to pay tax in India. This action, the significant economic presence comes from the BEPS, Base Erosion and Profit Shifting Action Plan number 1 of the OECD. Action Plan number 1 suggests the special tax as the significant economic presence. Okay, now India, what is saying? India is saying that transaction in respect of any goods, services, or property which is carried out by a non-resident with any person in India, including provision of download or data or software in India. Suppose there is a transaction between a resident and a non-resident. Okay. Suppose I am transacting with a non-resident, say what? The Netflix. Netflix is a non-resident. I am contracting the non-resident that the Netflix then take the subscription of your yearly subscription, whatever the price is. Suppose 9.99 is the price of the yearly subscription of Netflix. Okay. I have given the Netflix the yearly subscription for downloading the data. What is downloading the data? The data which is available in their website, the web series, the movies, everything whichever is there in the Netflix. I am downloading it. I am downloading or using that software as well. So for that, the what is the Indian law says? If the aggregate of the payment by a resident to a non-resident Netflix is arising from such transaction during the previous year exceed 2 crores. If it exceeds 2 crore, then we will say you have a significant economic presence in India and you have to pay tax in India. Okay, so what it says, if your aggregate of payment exceeds 2 crore, then you have to pay tax in India. Now, see, second point, there is a systematic and continuous soliciting of business activities or engaging in interaction with the users in India, like WhatsApp. So if they are earning anything from them, so the number of users should at least be 3 lakhs. So here are the limit is 3 lakhs, the number of users. If your number of users exceeds 3 lakh, then we can say that the users which are using your application is more than 3 lakhs of India. The users of India is more than 3 lakhs. Then you have a significant economic presence in India and you are going to give tax in India as well, apart from your residential country. Okay. Significant economic presence is not affected by following factors. What are those factors? Whether in India or not, there is a place of entering agreement, residence or place of business, whether in India or not, or rendering of services, agreement, rendering of services, residence or place of business, anything does not matter. If there is a SCP that we have determined the SCP as per point number 1 or point number 2, then you need not to check whether the agreement is there or not, what is the place of residence, where the business is taken care of, from where the services are rendered. You just not need to check any one of these. You just check whether the SCP criteria are followed, the condition 1 or the condition 2. Any of the conditions followed, then it is a significant economic presence in India and the company will have to give tax in India. Only so much of income as is attributable to the transaction referred to in A and B above shall be deemed to accrue or arise in India. Only that much will be taxable in India, which is accrued or arise. Like Netflix is earning income from various countries. Netflix is earning income from the various countries. So whether the Netflix income, the whole Netflix income which they are earning from various countries are taxable in India? No. The only income which is earning from India, the which is attributable to India, which are given by Indian resident to that non-resident will only be taxed in India. Is this point clear? Not the all income, but only the income which is attributable from India. Is this clear? This is the only point. Now coming on to the point, what is the Vodafone case law? Vodafone case law is an important case law. What it says, like, like suppose there is a company A, there is a company B, just a second, there is a company B. A transfers the B the share of company C, share of company C, which is an Indian company, the share of Indian company. Okay, A transfer the B the share of Indian company. Or if there if suppose it is an Indian company, then it's okay. But suppose it is not an Indian company. It is some another company which is a non-resident, but whose value, whose share value is derived from India. What it says, whose share value is derived from India. Then this transfer from A to B will also be taxed as a capital gains in India. Is this point clear? Now, what is derived from India? When we will treat that the income is derived from India, the share is substantially deriving its value from India, then we will discuss what is substantial, what it does means. Okay, till now, what is C? Income through transfer of capital assets situated in India is deemed to accrue or arise in India. Okay, but what is explanation number 5? An asset or capital asset, whether it is any asset or any capital asset, okay, being any share or interest in the company registered or incorporated outside India, shall be deemed to be and shall always be deemed to have been situated in India if the share or interest derives directly or indirectly its value substantially from the assets located in India. When the asset, when the share or interest is deriving the substantial value from the assets located in India, then the transfer from one non-resident to another non-resident will also be deemed to accrue or arise in India, and it is going to be taxable in India because of this explanation 5 of the Vodafone case law, introduced after the Vodafone case law. Okay, but now this explanation 5 is not applicable to the FIIs and the FPIs. Is this point clear? Now, what is the exception? Income shall not be deemed to accrue or arise in India. Above, we have said the income shall be deemed to accrue or arise in India. But here we are saying that income is not going to accrue or arise in India in the hands of the non-resident if the transferor who transfer the share holds directly or indirectly right of management or control. If the director does not hold, the transferor does not hold any right or management or control in that particular company, or does not hold 5% of the total voting power or shares at any time during the last 12 months. If that particular non-resident is not holding 5% of the total voting power, like it is holding only 4%, only 3%, only 4.5%, if these are holding only these much of a small percentages of the total voting power, like it is not the influential voting powers, it is not a substantial voting power, so we are excluding those type of non-resident from this point, because we are not want to tax any small non-resident. We just want to tax the major parties, major companies which are going to tax plan these type of transactions. So the government, through the explanation 7, has given the some explanation exceptions that the income shall not be treated as deemed to accrue or arise in India if the non-resident transferor holds directly or indirectly, is not holding any right of management or control in that particular company, or not holding 5% of the total voting power in the last 12 months, anytime in the last 12 months. If you are holding 5% for any one particular day as well, then it will be treated as deemed to accrue or arise in India. It should not be, you should not be holding 5% of the total voting power at any time during those 12 months. Is this point clear? At any time, not at the end of the year, at any time of those 12 months, then you will not be treated as the income which is earning from that substantial part will not be treated as deemed to accrue or arise in India. Now, what is meaning of substantially? When we can say the value is deriving substantially from the assets located in India. So we have to check on the specified date. What is a specified date? See, a specified date can be the last date of balance sheet preceding transfer. Like transfer happens today. What is the date today? Today is 23rd of August. So what is the last day preceding this transfer date? Transfer date is 31st of March 2024. So what is the balance sheet? The last balance sheet date it will be the specified date. This is the specified date, which will be the valuation date. So we have to value this. But in one case, the specified date will be treated as the transfer date. The transfer date will be treated as a specified date. What is that case? The book value of the asset on transfer date, like 23rd of August, the book value exceeds by at least 50% from the book value as on the last balance sheet date, like 31st March. What it says, suppose 31st March 2024, the book value of asset which are showing in the books of accounts is 100. But on the transfer date, like on 23rd of August, like 23rd of August 2024, the book value turns to 150, which is a 50% spike. Then it will be treated as a then specified date is the transfer date. Then the transfer date will be treated as a specified date. Only 15% is the tolerable limit. If that change is within the tolerable limit, like from 1 to 15%, from 0 to 15%, is there any change? Then there is no problem. Then you can take the book well, then you can take the 31st March 2024 as the specified date. But there is a change. There is a change in the book value on the transfer date by 15% from the book value as on the last date of the last balance sheet date. Then we have to take what? We have to take the transfer date as the specified date. Is this point clear? So, as on the specified date, whatever the specified date is, whether the last day of the previous year, last day of the balance sheet date, or maybe the transfer date, whatever the case is, which is a valuation date, we have to check on that particular date whether fair market value of Indian asset in the balance sheet there is a asset column there may be some few asset maybe from the India as well. So we have to check the fair market value of the Indian assets held by that particular foreign company is more than 10 crores. If the fair market value of Indian assets is more than 10 crores, and simultaneously we have to check another condition as well. Not We have to comply with both the conditions. We have to comply with both the conditions to say it is substantially deriving value from India. So we have to check both the conditions. First condition is clear that the fair market value must be more than 10 crores. Second condition, it must represent at least 50% of the value of the total asset of all assets owned by the foreign company. What it says that the Indian assets must be the 50%, at least 50% of all asset owned by that foreign company. Okay, so it should be more than 10 crore, and it should also be at least 50% of value of those total assets. If these both conditions, remember both conditions need to be followed because it is here is and if the both conditions are satisfied, then we can say the value is deriving substantially from India. If the value is deriving substantially from India, then we have to check what is the value. Now we have said the value of asset. We have said always the value of all assets. How we will calculate the value of all asset? So value without reduction of liability. We need assets value. So fair market value without reduction of the liabilities. Is this point clear? Now, what is a taxable capital gain? How we will calculate the capital gain which is taxable in India? So taxable capital gain multiply by fair market value of Indian asset divided by total fair market value of the total asset. Fair market value of the total asset. With this gives this portion gives the Indian asset proportion, which we have also calculated here, we have received the Indian asset proportion. Just multiply it with the total capital gain. We will get the Indian capital gain. We will get the capital gain which are derived from Indian assets. Okay, that is what is deemed to accrue or arise in India, which is what deemed to accrue or arise in India. What is deemed to accrue or arise in India? This capital gain must be deemed to accrue or arise in India. Is this point clear? This point is very much clear to you all now. Dividend declared and paid by such foreign company outside India shall not be deemed to be earned in India. If there is a dividend declared and paid by such foreign company outside India, the foreign company is declaring dividend and paid outside India, then it should not be deemed to accrue or arise in India. That shall not be deemed to earned in India. Is this point clear? This is clear very much. Okay. Now coming on to the last one. Coming on to the last point. So that is very important point. So just remember just remember this chart. This is the basic chart. If you do not remember this, no problem, but remember this chart. This chart is very important. You will get maximum number of questions if you are getting any question from the non-resident chapter and from the above portion, then you will be getting either from this topic or from residential status of the company. Major these two topics are important in this our portion of the residential status. And afterwards that we have covered like section 115A, 115AC, 115AD, 44C, all these are important sections. Okay. Now see, now we are coming to the income deemed to accrue or arise in India. If the interest, royalty, or fees for technical services, if any of these are given by is payable by, who is giving the interest, who is giving the royalty, who is giving the fees for technical services? If these things are given by the government of India, who is giving the giver is the government of India, then it is going to be taxable in India. It is going to be taxable in India in every case. In every case, it is going to be taxable in India if it is paid by the government of India. Okay. Now, but if the interest, royalty, or fees for technical services is payable by a person who is a resident in India, is payable by a resident in India, then it will be deemed to accrue or arise in India, except two cases. Except two cases. What are these two cases? If the money borrowed and used or technical services or royalty services. Money borrowed is for interest. Used for technical services, FTS, fees for technical services, and this is royalty. Okay, if any of these things are utilized for the purpose of business or profession carried on outside India, if these services if these interest is payable by any of the resident in India, because these are the business or profession are carried out outside India. I have taken loan and I am in paying interest. But for what I have taken loan? I have taken loan for my business which is running outside India. If for that, if for the business which is running outside India, I have taken loan and paying the interest, royalty or fees for technical services, anything on that, then it will not be treated as deemed to accrue or arise in India, as it is an exception. It is an exception. And the second exception is for the if the money borrowed and used for technical services or the royalty services, all the three conditions are there, are utilized for making income from any source outside India. I utilize for making income any source outside India. I have taken loan and invested in any other country and earning from that investment source in that particular country only. So I am making income from any source outside country. Then this will also not be treated as income deemed to accrue or arise in India. But these cases are just reversed. But if these interest, royalty, fees for technical services are payable by a non-resident, now see, everything is reversed here. What is it is outside India, outside India. For a person resident in India, we have to see outside India. And for a non-resident, we must see carried on India, making any source of income in India. Just this is, but here it is exception. We are not treating it income accrue or arise in India. but for a non-resident, we are treating it income accrue or arise in it. Just a second. In India. Okay. Now what it says, if money is borrowed and used for the purpose of business or profession carried on India, or if the technical services or the royalty services are utilized for business of profession in India, or in India, or making income source from any, if making income from any source in India. What it come here is carried on in India or in India. Okay. For non-resident in India, and for a person resident in India, we have to check outside India. For outside India, the person, this is the exceptions. So what we have to check, whether the business, whether the interest or royalty fees for technical services is utilized in India. If it is utilized in India, then it will be taxable to all. For a resident as well, for a non-resident as well, and for the government in every case. Is this point clear? This is the whole chart. Now coming on to the last point. What it says? It says whether the income accruing or whether income arising outside India, being any sum of money paid without consideration by a person resident in India to a non-corporate or a foreign company or to a non-RNOR whose where aggregate sum of payment is 50,000 rupees. As you know, under section 56 to 10, gift up to 50,000, the money which is given up to 50,000 is exempt. But if you are giving anything more than 50,000, then it will be taxable under section 9, subsection 1. Okay, is this point clear? Now, see, this section is only applicable on sum of money. What it says, see, what it says, any sum of money. So this section is only applicable on sum of money, and any other gift in kind will not come under this section. Okay, any other gift in kind. If you are giving gift in kind for more than 50,000 rupees, then it is not going to be taxable here. Is this point clear? This is only for sum of money. Is this point clear? Clear. Now, what is the definition of royalty? You do not need to study at all. You can skip it very much easily. But what we have to study, we have to study the this box. The lump sum consideration for supply of computer software embedded in the computer hardware. Like when you purchase the computer hardware, when you purchase a computer, the inbuilt Microsoft Office, the inbuilt Windows, the activated Windows comes to you. So you are paying the lump sum consideration for that hardware. Okay, so it is not a royalty for those softwares. Okay, it is not a royalty for those software. It is said by the CIT versus Alcatel Lucent Canada case. Okay, now payment for downlinking television channel constitutes royalty. Consideration for sale, distribution, exhibition of films is a royalty, or a consideration for use or right to use of computer software is covered under royalty. If you are giving any right to use the computer software, then it will be treated as a royalty. Is this point clear? This is the easiest point that I have covered. Okay, now the last point. Engineering Analysis Center of Excellence Private Limited versus CIT and others 2021 Supreme Court ruling, which is important. You need to remember the case law name. You need to remember this case law name. Remember this. Remember this. Okay. Now, what it says, the amount paid by resident Indian end user or distributor to NR software computer software manufacturer, like any resident Indian is paying end user. Any Indian resident is an end user, like he's an end user, he's going to consume that software, going to use that software. Okay, he's paying to the non-resident the price, or the distributor of a non-resident computer software manufacturer, the distributor of the non-resident computer software manufacturer, or suppliers is consideration for resale, or the supplier who will be paying the consideration for resale the goods, as the supplier will always resell that good particular good, or the use of computer software through the end user license agreement, or distribution agreements. Either you are distributing it, either you are selling it for the end user license agreement, you are a supplier who is selling for a consideration, who are reselling for the consideration, or you are a distributor to non-resident computer software manufacturer, or you are a final resident in India end user. If you are any of these, then it will not, the computer software, the payment for that particular computer software is not royalty for the use of copyright in the computer software. It will not be treated as royalty. Is this point clear? It will not be treated as royalty. This is your whole chapter of non-resident taxation. We have covered the whole chapter of non-resident taxation, the pending portion, in just 1 hour only. So this is all. And for that, who haven't enrolled yet for the test series that I have launched, the direct taxation exemption test series, if any one of you haven't enrolled it yet, the link is in the description box. Must enroll that test series. It is going to be a game changer for you for DT November 24 examinations. So this is all for the day. We have completed the whole non-resident taxation. Now, in the upcoming week, we will be going to cover the transfer pricing chapter. Is this clear? So take care till then and keep on revising everything. Is this clear? Now we will meet at the next week and complete the transfer pricing chapter. Take care and bye.